Before I start this week's show, Andy, I'd just like to say a quick thank you to our sponsors this week, and they are Hargreaves Lansdown. And for more information about Hargreaves Lansdown, go to hl.co.uk. And Pension Bean. If you want more information about Pension Bee, go to pensionbee.com. And don't forget, with investing, your capital is at risk, which means it is possible for the value of your investments to go down as well as up. Now, on with the show.
Hello and welcome to episode 362 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leeks. Damien, we're back. How are you doing? Welcome to the pod.
Yeah, I'm good. It's quite nice that you and I both are sounding normal, because I think the last couple of times either one of us has had a cold of some kind. So I'm good. It's been a very busy week this week. We had a bit of this, the spring statement, which we're going to touch upon in the podcast. And we've had lots of other pieces, stuff I've been doing for journalists as well, which again leads into the podcast this week. So all good. Actually, we've got so much to crack through this week. I'm conscious of time. So what I'm going to do is start with a quick review that we received this week, one of my favorites, which I'm going to read out before I crack on with the show. So this is a review on iTunes, and the title of it is In the Notes, 5 stars, and it says, one of the very best finance podcasts available. Presenters are not only knowledgeable, but articulate and interested. Make this show one of your weekly listens. I think that's one of the first times I've ever been called articulate, Andy, which I'm going to take, and I'm going to grab that and run with it this week. The funny thing is that Andy normally has to edit the hell out of the show because I might have made a few mistakes along the way. So I do sound articulate because I'm letting you behind the curtain here. Andy makes me sound articulate. So thank you for the review. Please do send in your reviews and share the podcast with as many people as you can, because it helps us grow the fan base of this particular podcast.
Okay, so you mentioned earlier that we're going to cover the spring statement a little bit later. So that's one thing on the pod. What else have we got?
So one of the other pieces we've got is an investment piece, and it's about investing for inflation. Touched upon the idea of inflation and investments in my midweek market show. But I was asked this week by one of the national newspapers for my fund tips for investing. So what I want to do is talk about how I went about discovering which funds out there might potentially do well in a high inflationary environment. And the last piece of the show will be invited Harvey back on, because we had a question from a Twitter follower regarding getting income protection, health insurance and life insurance with a pre-existing health conditions. And these health conditions were long COVID and PTSD. So it was a very interesting question. So Harvey's coming back on the show to explain what the current situation is and actually give that person quite a bit of hope.
Okay, so let's start with the spring statement then. Damien, you're going to provide us a quick summary.
Yeah, so there wasn't too much that was announced that hadn't previously been known. So it's going to be a pretty succinct piece on the podcast. So the main thing is that there was always going to be a 1.25 percentage point rise in national insurance. That had been pre-announced, and we knew that was coming, and that was to fund the NHS and social care. And I hate people who talk about percentages, and I keep seeing people saying it's a 10% hike on national insurance because of the increase, but you're going to see an extra 1.25% added to the current rate of national insurance that you pay. Now, what was different is that Rishi Sunak announced that they were going to raise the threshold at which you start paying national insurance. Now, that was something that was a bit surprising, I think, caught some people by surprise. They thought it was quite interesting because he had been getting a lot of stick about potentially scrapping this hike, but the Conservatives wanted to keep it. It now means that you won't start paying national insurance until you earn £12,570. So that threshold has risen by £3,000. And the headline number is that it's going to be an equivalent of a £330 per year tax cut for employees. Now, let's just give the overview of what does that actually mean compared to now. Now, if you think about it, they've increased the national insurance. We said you're going to end up having a 1.25% added onto the current rate of national insurance, but the threshold has been raised by £3,000. So what that means is that if you earn above around £35,000 a year, if you crunch the numbers, you will be worse off, even with this new threshold change, than you would be currently. And if you earn under £35,000 a year, you'll be better off than you are currently, given the latest announcement. So that is the takeaway that you sort of hang on to. So that was quite interesting. The other announcement relating to tax is that he will be cutting the basic rate of income tax from 20p to 19p in the pound before the end of this parliament, which is 2024, although that's not obviously being actioned yet. And I think Rishi is always quite keen to say about judging by his actions. Well, this isn't an action, this is a promise. So I almost exclude the fact that that's even happening. This is not me just being cynical, but it's obviously coincidental. It's happening in an election year, isn't it? So it can be a bit of a vote winner. So the other thing that they're providing support of an additional £500 million in funding for vulnerable households to cope with living costs. So if you are struggling with the cost of living, then do contact your council, because there is more money there that can help you potentially. And they announced that people installing green energy solutions, so things like solar powers, heat pumps and insulation, will not have to pay VAT on that. So there was a nuance there, which you can look into the details. We've got an article on the website, but that's hardly going to excite many people. And the other thing that was probably the headline grabber was a 5p per litre cut on fuel duty, which has already come into force as we make this podcast. And that measure will stay in place until 2023. Now, what does that mean to ordinary people? It's basically about £3.30, according to the RAC, off the cost of filling up a typical family car. So I'm hardly going to get excited about that. So I think the overall summary was, for most people, this wasn't really much of a giveaway. There were some tweaks to make some of the hikes in tax more palatable, with changes in thresholds and promises of cuts in the future. And saving you £3.30 on fuel duty is hardly going to be something that's going to make a big difference, certainly not to energy prices and the bills that we're paying. So I think overall people would think that was a little bit disappointing. So what can you do about fuel prices? Well, shop around. It's always going to be the same advice. Sites like petrolprices.com. And just before we came on air to do this show, Andy was saying about the variation in prices he's seen already in the forecourts, or that exist out there. So it is definitely worth shopping around.
Yeah, it's absolutely crazy. I pass 4 or 5 petrol stations on the way to get into work, and the difference between those was actually 21 pence. Can you believe it? 21 pence a litre between the sort of most expensive one on the way in and the cheapest one. And these aren't motorway service stations. These are normal forecourt petrol stations that are on standard roads. So how you find that 5p saving, I don't know. I suppose really we need to be shopping around. We're in that phase now. It pays to shop around. And actually I use a Waze app. And on that Waze app, it does tell you local petrol prices as you're approaching them. And you can actually punch in the numbers and help other users as well. And you get a little tick for doing it.
You get a little bonus, do you, that makes you feel good. As I said, petrolprices.com, I think they've got an app, and you can look at the prices of various different petrol stations. It'll tell you the cheapest one near you. Just before I move on from the spring statement, I just wanted to make people think back to the episode I did, podcast episode 355, and I talked about the difference between the poor and the rich. And in there, I started to talk about, I went on a bit of a rant, to be honest, which was about taxation and about how the system is rigged. And if I'm going to be objective here and look at what was announced, and again, this isn't political, this is me just looking at numbers. They changed the national insurance levels, which is obviously a positive for some people on low incomes, but cutting 5p a litre off of petrol doesn't impact the people on the lowest incomes, because they're unlikely to actually have a car. And people being able to afford to install solar panels on their roof, which costs probably about £5,000, is not probably going to be people on the lowest of incomes, especially if they're living in rented accommodation or they're living in flats, because they wouldn't be able to install that kind of thing like solar panels on the roof anyway. And it was interesting because you could argue that while we are seeing a general hike in national insurance, so like I said, for those people who earn over £35,000, this is definitely going to be worse for them. But they are mentioning that in the future, they're going to try and work towards this income tax cut of a penny in the pound. And obviously that's a positive, but you could step back and say that, yes, while somebody who's working benefits that, these changes in the round benefit most those people who have an income which isn't earned. So if you earn your income, you're going to have to pay more national insurance. But if you are somebody who has investments or pension, for example, so pensioners, don't forget, when you get above the state retirement age, you don't pay national insurance. This doesn't impact you. And you're also going to be receiving in the future a cut to the level of income tax you pay, which will help again pensioners. This is where the disparity comes in. And this is where some some of the inequality just gets widened. So people who have to earn their money, who are working, are worse off on the whole, and the people who aren't, who may be wealthy, generating income in other ways, are actually better off. So anyway, I'll put that to one side, but it just reiterates everything I said in that podcast when I went on a bit of a rant. So investing for inflation, Andy, let's go straight into that. So I was asked by a national newspaper for investment funds that can benefit from inflation. Now, I can't go through everything that I'd written for that because it hasn't been published by them and it's not really good form to do that. So what I will do is explain to people how I went about looking for those sorts of funds. So there's a really interesting piece of research that was carried out last year by Schroders, and I'm going to link to the image that was produced from that piece of research. It will be in the show notes on the post for this podcast on the Main to the Masses website, and you'll be able to see it. Now, this piece of research looked at the equity sectors out there. So when we talk about equity sectors, you can take companies and put them into groups of similar companies that do similar things. So, for example, energy companies, so energy providers, BP, Shell. You can put it into companies that are financial companies, so some of the banks and insurance companies. You've got things that might make utilities or people who do healthcare, so things like medicines, or you might have things that are IT-based companies or companies that sell things that are consumer discretionaries, and that means things you don't have to buy, versus you've got sectors called consumer staples. Those are things we'll always buy whether there's a recession or not. So all equities can be bunched into these different sectors, and what is interesting, different sectors react differently to different economic environments. So if you think about it, utilities, we have to pay for them because we have to pay for them no matter what, because we need them to live. Something that's a discretionary purchase, so some form of maybe retail or whatever, that we could go and buy something we don't need but we would like. If the chips are down and the economy is stalling and we're worried about our money, we won't buy those things. Food, for example, we've got to buy. Medicine, we have to buy. So those things tend to do quite well. Oddly, things that will typically will also do well will be things like tobacco and stuff like that, because people who smoke don't tend to stop smoking just because there's a recession. So you get different types of companies do well in different economic environments. So financials have always typically done well in a high interest rate environment because the rising interest rates can be quite good for their profit margins, certainly in the short term. So what this piece of research that Schroders did is looked at the US market and analysed recessionary periods over nearly 50 years and looked at each sector and said, well, how did they perform? And they created this chart that had 4 quadrants in it. So if you visualize that while you listen to the podcast, and up the y-axis was talking about the average 12-month inflation adjusted return percentage that they'd made. So think of it this way: how much would they make during these periods of inflation? Then along the x-axis, they had the probability of them actually beating inflation. So what you really want is, if you look at the image or imagine it, you want stuff in the top right-hand quadrant of this image, because it's the things that are likely to beat inflation, provide inflation-beating returns, and it's also the ones that are going to produce the highest inflation-beating return. So when I was thinking about how am I going to find equity funds, for example, that would beat inflation, you need to find funds that invest in energy. You want to find funds that have exposure to equity REITs, so that's real estate investment trusts. And the reason that works is because they can pass on rising costs through rising rents. You want to have things like consumer staples. So those, again, are the products out there that we buy no matter what happens, because you can put those prices up. Again, think of products that you buy week in, week out. If the price goes up, you'll still buy them. You might find cheap alternatives, but you're not going to suddenly stop buying those products. Utilities and healthcare. So again, those are things like medicines, and other sectors that do tend to do quite well are things like industrial. So those are the sectors, and obviously within those sectors are the various different companies. Now, if you go and look at a fund fact sheet, which you can find the fund fact sheet of any fund out there by searching on your platform that you choose, and typically they will show you the sectors that they're exposed to. They'll show you the top holdings because they have to, but it'll also show you the sector weightings. So what I did, and I did a new piece of research this week as well off the back of the idea really of the request from the national newspaper, was to go, well, how would I go and find these funds and I analysed 2,000 funds, including unit trusts and investment trusts, to see which funds had exposure to these sectors, and then came down to a short list of those that had exposure. When I looked at it, you really wanted to focus on funds that had at least 30% of their assets exposed to these sectors that I've just mentioned. And the higher the exposure, the better they will do in these inflationary environments. It isn't guaranteed because it matters which companies they're invested in. These are just sectors. So I'm going to give you a good example. You could invest in an energy company, but if that energy company is in a global fund and that company is in Russia right now, you're going to be sitting on some heavy losses. So what I did was screen out funds that had performed negatively over the last 3 months, because that will take out any of those companies that have been hit by what's going on in the current macro environment and the geopolitical environment. So if you're listening to this podcast and you're thinking, will this fund I'm looking at do well? See if it's exposed to energy, consumer staples, utilities, healthcare, and industrials in particular. Less so financials, although they do tend to beat inflation on more occasions than not, but the average return isn't that great. Now, one thing that is interesting, they did also look at the market as a whole, the US equity market, so across all the sectors, so as an average. And it's a conventional wisdom that the equities will perform well in inflationary periods over the long term. And actually, this suggests they don't. It's just below a 50% chance that they won't outperform inflation as a whole, and actually they'll return on average a slightly just negative, so about a 1% 12-month rolling inflation adjusted return. So it isn't just buy any equities, definitely not in an inflationary environment. There is this divergence. The things you want to avoid are those technology stocks, those telecommunication companies, and consumer discretionaries. Now, you will have noticed I mentioned tech stock, and they are typically growth stocks, aren't they? So we talked about it on the podcast before. They're the businesses that grow over time, and their future profits tend to be quite a way off in the future, and they tend to underperform in an environment where interest rates rise. And when interest rates are high, that means that the future profits, when you discount them back to today's money, it's less attractive. If you think about it, the share price is just a discount of the future earnings and profits that you're going to get in the future. So interest rates are high, typically in high inflationary environments. So that's why top tech stocks don't do so well. But conversely, when you start to do the research and find the funds that are exposed to those sectors that I said do well, you tend to end up looking at some of the value plays out there. And what you find is you spend a lot of time in the UK equity income arena. So those funds, if you're looking at unit trusts that inhabit the UK equity income sector, I say sector again, that's what it's called. It's different from the sectors that I was talking about earlier. They're the ones for equities themselves as general. I'm talking about the group of unit trusts. They still use that same word sectors, which isn't really helpful, but UK equity income funds. And that's because they look for reliable dividend payers, and the reliable dividend payers are normally those businesses that people will buy from across an economic cycle. So they will be things like tobacco companies, there will be things like energy companies in there, reliable dividend payers. So that is a great place if you want to go and look for potential funds that do well in inflation, is that sector itself. And if I give you a broad steer, I reckon at least half of the funds that I identified came from that one sector alone. Now, if you want to look at investment trusts, there are very few investment trusts that tend to do well. And one I will mention that appeared in the list, this isn't a recommendation, it's just because I find what the investment trust does quite amazing. The City of London Investment Trust is one of those funds that I identified that invests in those key sectors, but that investment trust has managed to raise its dividend every year for 50 years in a row. So it's paying a growing income stream over 5 decades. That is incredible. And we talk about the income heat maps on 80/20 Investor, which is the DIY investment service that I run, and it identifies that fund year after year as one that provides a good, reliable, growing income stream. So that is something that's worth looking at as well. And more broadly, outside of equity income funds or equity funds just generally, what about other types of asset? Now, there'll be people out there who might be thinking in terms of bonds to buy index-linked bonds, because they will have some form of inflationary protection in there, but they still remain incredibly volatile. So if you invest in them, there's no surefire way that they will necessarily make money in an environment like that, and they're still volatile. So you can gain exposure to things like that in some multi-asset funds out there. And also, if you look, there are multi-asset funds out there I'm not going to mention one of the funds that's in my 50k portfolio, but 80/20 investor members will recognize it. It has exposure to gold miners as well, and gold is supposed to, or people say, is a good inflation hedge. It doesn't always work that way, to be honest with you. It doesn't really hedge well against inflation. It just does well in an environment where real interest rates are falling. But where I'm going with this is that you can get multi-asset funds that invest in different types of assets. So inflation-linked bonds, things like exposure to gold, as well as equities that can provide inflation hedges. And some of the multi-asset funds you see out there, they will have a mandate, an investment mandate. So that's the promise of how the fund is going to be run, will have an inflation mandate. So, for example, they will say they might beat the UK retail prices index over the longer term of 5 to 7 years. So if you're looking for funds, do look at the mandate as well, because some of them do have a specific inflation mandate, and therefore those managers will be doing what I've just described and looking for the assets and equities that will tend to outperform in an inflationary environment, because that's their mandate. So most people never look at that mandate probably, but that's interesting. The other thing you could do is, if you're looking for different types of assets, is some of the commodities out there. And there's been some roaring commodity prices. We've seen oil rallying. Gold has rallied partly because of the fear around the Ukraine situation. But there are funds out there, for example, things that will invest in farming. So you can go and Google things under the commodities space, things like, I don't mind naming the fund, but Barings Global Agriculture. Again, it's not a recommendation, but you can see they invest in all areas of the farming process around the world, from fertilizers to machinery and all that kind of thing. And so some people can look to try and play that whole inflationary price surge in foods, for example, by looking for exposure to certain key commodities. So there you go, Andy. That's an overview of how you start to go and look to invest for inflation, and in particular investing via equities. And although I focused on growth investing there, so people are growing their funds, as I mentioned with the City of London Investment Trust, it's really important, if you invest for income, you still got to be mindful of inflation, because it's the thing that's going to probably damage your wealth the most over the long term. Okay, as mentioned at the start of the show, Harvey is back on this week's episode to talk about health insurance and life insurance, because we've had a question from a listener via Twitter. So first of all, Harvey, welcome back to the show.
Thanks for having me, Damien.
Okay, so the question I've got came via Twitter from somebody called Offside14, and it says, "Hi fellas, any chance of covering health and life insurance options for people with chronic illnesses? I'm an NHS doctor who got COVID and was ventilated for 2 weeks, now having long COVID symptoms and PTSD. Being let down a bit by the NHS, looking for cover for myself, my wife and 2 young kids." So obviously immediately said, I've got to talk to Harvey about this one, and she's the expert on life insurance and health insurance. So Harvey, I'm going to pass this straight over to you. So what is the answer on this?
I mean, the answer is that it's a lot better than it was at the beginning of the pandemic. So what we saw initially was a little bit of hesitancy in terms of providing cover to those people who had COVID. But now we're in a space where insurance companies have established good response times and good responses to those people who have suffered COVID in the past. And largely the cover remains the same. So we didn't see insurance companies pull cover for things like COVID. And largely we saw insurance companies pay a lot of claims for people who were either unable to work because they were ill and were signed off from being able to do their normal jobs. And unfortunately, a large amount of life insurance policies also paid out for death claims that arose from COVID cases.
So if we start with the life insurance part of this question, because I think that's probably a little bit easier to deal with first. So in terms of life insurance, what's the situation? We talked actually on the podcast a couple of weeks ago about the situation with people, whether they cover COVID if you haven't yet had it. And the short answer is that they will do. But what about if you've got long COVID? Does that make an impact on the price you pay or the chance of getting life insurance if you apply for it?
Yeah, so to answer that question, Damien, you have to think about, well, what is long COVID? And long COVID is different for different people. Symptoms can be wide ranging. So some people suffer fatigue, some people have neurological problems, some people still have that loss of taste and smell that has continued beyond the period that they actually had COVID for. And depending on the symptoms that you've suffered with your long COVID and whether they're still ongoing, will have a lot to do with how you're treated when you get to application stage for life insurance. So every case is taken on its own merits, and insurance companies are not particularly assessing you for long COVID. They're assessing you for the symptoms that you have presented and how long it's been since you last had those symptoms as well.
So it sounds to me that actually the positive is if the long COVID symptoms are perhaps not too severe, that they actually could get life insurance on the ordinary rates that somebody who didn't have long COVID would get as well. So they wouldn't necessarily have to pay anymore. They would still be covered. So that's right, isn't it?
Definitely. So life insurance is generally available for people who have had long COVID symptoms, depending on the severity of the symptoms, how it's affecting them. Our question that we had related to an individual who had been hospitalized and ventilated with COVID. And actually, if you were hospitalized and you were ventilated or you received treatment in a hospital for life insurance, even a lot of insurance companies will wait a period of time after your last symptoms before they start offering things like life insurance. So you've just got to be aware that there may be some waiting to do even after you've recovered, so that you can get the best possible chance or cover with the best possible terms. The best thing to do, Damien, and we say this quite often, is if you have symptoms of any description, be that long COVID or any other kind of health condition, is to speak to a specialist life insurance advisor. They usually have access to the whole of the market. Make sure that the person you're speaking to does have access to the whole of the market, because what those individuals will do is they'll understand what your health condition is, what symptoms you're suffering. And from there, they'll be able to source the insurance company that's going to be fairest to you. Not all insurance companies have the same guidelines. And this is something that we repeat over and over again for listeners, because it's something that a lot of people generally don't understand, is that one insurance company won't behave in exactly the same way as the next one. So the best thing is speak to an advisor who will be able to point you in the direction of an insurance company that will give you the best outcome when you apply for your life insurance.
So for the person who wrote in this question, the good news is that yes, there's every reason why they should still apply for life insurance, particularly because they've got a wife and children as well. That's obviously important. And before I lead on to the next question regarding, for example, income protection and health insurance, we will link through to a insurance specialist like Harvey mentioned in the notes of this podcast. If you listen to it on something like iTunes, you'll find it in the show notes, or if you go on the website and find the post for this episode, then you'll find the links through there so people can actually go and take some action and take a step further. Now, the other part of that question actually mentioned PTSD, post-traumatic stress disorder. So what's the situation with that in life insurance?
So PTSD is a specific kind of mental health condition. So, it's something that has reared its head during this COVID period, especially for those people who were frontline workers, maybe key workers, people who saw the real challenges of the COVID period. But PTSD, like I said about any other condition, it's really going to depend on how that's impacting you. One of the questions and difficult questions that anybody who discloses a mental health condition is asked is, have you had any thoughts of self-harm or suicide? And that's a really difficult question to answer for people who are in that position. But that generally is the signal to no cover. So if you answer yes to that question, then generally cover isn't available. But that's probably the extreme end of a lot of mental health conditions. And most mental health conditions will be somewhere on a sort of barometer where you'll be assessed according to the symptoms that you're suffering and how well controlled it is as well. Because if you've seen a doctor and you're on medication and that's controlling your symptoms, and you perhaps haven't had symptoms for a long period of time, that again is a positive and, will help you to get covered in place.
So does that mean that they will write to your doctor
Not necessarily, Damien. So in most cases, a person's mental health condition is best described by themselves. Doctor's notes can help that and supplement that, but largely insurance companies start by having a conversation or just sending a questionnaire to the individual concerned. So they'll want to understand how you see your condition and what you're suffering and what your symptoms are and how long it's been. Things like time off work can be an indication of the severity of symptoms, but it's only in situations where a person couldn't answer the questions or couldn't provide enough detail for the insurance company to make a good assessment of their health that they would go and write to the doctor for more information.
Now, Harvey, moving on to income protection and health insurance. Now, what's the situation for this person with regards to those types of insurances?
For somebody in this person's situation, it can be difficult to get health protections. As you can imagine, if you are currently suffering a mental health condition, you're probably a little bit more at risk than the next person for not being able to work or for claiming against something like a health insurance policy to have the counselling or other treatment that you may need. So that's important to note. That doesn't mean to say that cover isn't available. Again, I'd really like for listeners to understand that every person who applies for these kinds of insurances is assessed individually. So there could be some detail that we don't have about this individual that lends to them being a good candidate for insurance. And actually, it's going to depend a lot on whether they're still working, how long ago they were off work, if they were off work. Income protection pays out if you can't do your job. So if you've recently not been able to do your job because of a medical condition, chances are that either you'll be declined for the cover or you'll perhaps be postponed. So a postponement basically means that the insurance company may be able to offer you cover, but they're not going to offer you cover right now. They want to see you back at work for a period of time before they can do that.
And you make an important point there, Harvey, because I think a lot of people might hear stories or they might hear people who have similar conditions to them who say, well, there's no point applying. I applied for various insurances and I was declined. And actually, there isn't one hard and fast rule, as you say. It's always worth applying anyway because it doesn't cost you anything. You're going to go through and you're going to get the advice, all going to be free, and then you will find out whether you get cover or not. It's no point just not trying. In regards to health insurance, obviously there's clearly going to be some limit to somebody who has particular conditions that are existing in terms of them being covered under that policy because there are normally exclusions. But we talked in the office and you mentioned a good point actually about even if they took out a policy that covered their wife and children and maybe not everything for them personally, that the services that are available on these policies are still useful in this instance.
Absolutely. I mean, health insurance is very much like income protection, so the same sort of situations that lead to people not being able to work are similar to the situations where they're claiming on health insurance. It is important to, again, and I'll keep repeating this, but speak to independent specialists when you go to buy these kinds of insurances because the kinds of exclusions that you see in these policies do vary from one company to another. So one insurance company may not cover anything that's chronic, and something like PTSD might be deemed chronic, so that it's really important to speak to people who understand the terminology within the policies. There's a lot of jargon that might not mean anything to the layman, but in real terms, you want to speak to somebody who's working for you and can explain to you what a policy will and won't do for you in a situation where you might need to claim, especially if you're particularly worried about claims that you may make in the future, or you're worried about particular situations happening. Perhaps somebody close to you has been through a situation, or perhaps you've had experience of being off work and you don't want to leave yourself vulnerable to that again. But when it comes to even life insurance, income protection, critical illness cover, health insurance, all of these kinds of policies, many insurers provide peripheral benefits. So you get things that are generally referred to as added value services in the industry, but what you might see is an enhanced benefits package, or member benefits is sometimes what it's called. And what that does is, even if you're not claiming for the main benefit of your policy, you can access things like virtual GP services. So you might have 24-hour, 7 days a week access to a GP. And that can be really beneficial for somebody who's struggling to get a GP appointment to start discussing their health condition. There's also a lot of mental health well-being type support through these added services. And again, you don't have to be claiming in order to access them. And they can be a great starting point where, especially in today's climate, we're getting a lot of news come through that people who need mental health support are having to wait really long periods of time through the NHS. So it can be a cut through for those individuals, and those benefits extend to members of your family as well. So if you've got a policy, then generally your wife, your children can use those services if they need to.
And just to wrap this up, Harvey, because there's a couple of points there I just want to really emphasize that you've made. So like the GP services, some of them will even provide prescriptions as well. So there are people, if you're anything like me, I find it almost impossible to get a GP appointment now. I can't book a GP appointment now within a week of needing one. And sometimes you don't actually need to necessarily see a GP, you just need a bit of advice. These added benefits, I think, are now gaining more value in terms of people who take out the policies, and actually people are noticing them, because there are reasons why I've now looked at policies. And I'm quite open on the podcast about my own health problems and my Crohn's disease, but you've got to bear in mind that I've got life insurance, for example, that covers me for, obviously, if I die from Crohn's, but it's at a decent rate because I went to an insurer after having advice of the one that was the most lenient when it came to covering somebody who had Crohn's disease, but my particular medical history, my past history and experience of Crohn's disease and the operations. Equally, income protection, never thought in a million years I'd ever be able to get anything like that. And Harvey, we did a piece recently on a podcast where through work, I was able to be covered even for Crohn's disease, and health insurance as well. You can get, I mean, not everything is going to be covered, but of course you do get a period where you have moratoriums and things like that. So there are certain circumstances where I would be able to make claims under a health insurance policy that I didn't believe I would have done in the past. So it's definitely worth seeking the advice. And the one thing I just want to reiterate again, Harvey mentioned at the end there about those other benefits for your family. So we've all got children, and the pressures that they've been under the last couple of years, and particularly I saw a story the other day about the rise in anxiety in adults, but also teenagers. There are services that you will get that are free that they can access, even if it means they need just to talk to somebody. And then you get so many sessions where they can talk to this person. It's not a claim on the policy. It's just access to somebody to talk to who is experienced in dealing with that matter. And I think that personally is priceless, because if you ever tried to do anything like that on the NHS, it is very difficult to get a referral, or probably even B, to actually get an appointment this side of Christmas, to be honest with you.
And just picking up on what you were talking about with regards to the group benefits, I think an important point to make is that if you find yourself in a situation where you've spoken to a specialist advisor, you can't get the kind of cover that you need, or you can't get it right away, and you want that peace of mind, do speak to your employer. Group schemes are a good way of being insured. Just like you described, you were able to get cover through the work scheme that we have. But also, if you're already a member of a scheme, talk to your employer and see if you can't enhance some of the benefits within that scheme. So whether you want a little bit more life insurance, or you want income protection or some critical illness cover. And what you'll find is that with being covered through your work, you don't have to answer medical questions. And that can help avoid just going into any kind of assessment process and offer you cover despite what your current health condition and state might be.
So thanks, Harvey, for coming back on the show. I think that was a brilliant piece. And just to reiterate to people, you can ask us questions any way you want, via Twitter, whether it's email. You can email Harvey directly if you want to, if you've got any questions. She can't give you advice directly, obviously, but harvey@moneytothemasses.com is the email address. So there we go, Andy. I think that's it for this week, is it?
It is, but you probably want to mention Grow It, because you haven't done it yet.
Actually, I haven't. Yeah, good. I should have done that at the beginning. Every week I get things around the wrong way. I should have mentioned Grow It at the beginning. Don't forget, our Grow It campaign is still running. It's the last week 4. So the whole Grow It campaign, if you've missed it, is building off the back of our 3-stage process of controlling and sorting out your money. Own it, fix it, grow it. Own It was building the black book, basically getting down in writing where you are and how your finances are set up. Fix It was fixing the bits and pieces that are wrong and improving your finances before we got to the stage where you could grow it, which is about growing your wealth and learning about investing, particularly via stocks and shares, ISAs and pensions. But next week on Grow It, we're going to start looking at some of the esoteric stuff. So we're going to touch upon things like IPOs, Bitcoin, NFTs, things that some of the regular listeners to the show will have heard, but we're going to have more content for people on Instagram around those topics. So if you want to take part, don't forget the way it works. You don't have to have started it back 3 weeks ago. You can start it whenever you want. Go on our Instagram feed, look at the highlight where you'll see Grow It. You can find day one. Start from day one if you haven't started already, and do the task in sequential order, day one, day two, and then you can eventually go through at your own pace, and you should learn a hell of a lot about investing. And we've received some great feedback from people, actually, I should have mentioned, who thanked us for the way we were doing the whole Own It, Fix It, Grow It campaign. That's this structured way so they can follow it through. So make sure you take part in that as well.
And so if you want to get in touch with Damien, you can do so in the usual way. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with number 2. And again, go onto Instagram, find that Grow It campaign, join in with the fun, and we're done for this week.
Yeah, until next time.
Until next time.